If you've been told to start drawing from your RSP as soon as you hit retirement, then this video is for you. It's something that I've talked quite a bit about on this channel, and a lot of people think it's the right thing to do. But it's not the right advice for everyone. And a lot of retirees are shocked when they find themselves pushed into a higher tax bracket and handing over way more to the CRA than necessary. I've spent years helping people in this exact position, making tax-aware income plans that fit around pensions, corporations, and other investments. And the truth is that the RSP drawdown or meltdown is a tool and not necessarily a rule. And if used incorrectly, it can end up costing you a fortune. So in this video, you'll see why you might not want to touch your RSP yet, which account to draw on first, and how to avoid the real mistakes that people make when planning their retirement income. A lot of Canadians heading into retirement are told the same thing. Start drawing on your RSP early, because if you don't, you might be hit with huge withdrawals when you eventually convert that RSP into a RIF at age 71. Additionally, whatever is left in your registered accounts when you die is all going to get taxed in 1 year, unless you have a spouse where you can roll over those funds tax-free to their registered accounts. But that advice isn't always right, especially if you're already in a high tax bracket. Pulling early can create a larger tax bill. This is what happened to Mark. Let's start off by saying he has a great name. And Mark was in a unique situation that I found interesting when I first met with him. He's 62, widowed, and has $1.1 million in his RSP, $180,000 in his TFSA, and $1.2 million in his holdco. Prior to retirement, Mark was a business owner, and this is why he had funds in a corporation. He also had a small RSP, but the account grew substantially when his wife passed and her RSP rolled over tax-free to him. Mark had a couple issues that he wanted to address. Every year, he was filing a tax return for his corporation, which he found quite costly. Additionally, on the investments inside his corporation, he was being taxed at the highest rate. Because of this, Mark wanted to dissolve his corporation over the next 10 to 15 years so he can move those funds to his personal hands where he wouldn't be taxed as aggressively. His second issue was his now large RSP. He knew that upon his death, whatever was left in that account would be taxed in 1 year. This meant that a lot of his savings would be exposed to a tax rate of over 50%. Due to this looming tax bill, he also wanted to draw down his RSPs quickly. Now, just before we move on, if you want to make sure that you're not missing a single opportunity in your own plan, then check out our free 20 retirement tip guide inside of our retirement toolkit. These are the exact strategies we use with clients to keep their tax bill as low as possible. Check it out using the link in the description. For 2025, Mark planned on taking a $100,000 eligible dividend from his corporation. At this rate, he'd have his corporate funds depleted over the next 10 to 15 years. Personally, when you draw an eligible dividend, it is taxed quite favorably. As we can see, this $100,000 withdrawal is only costing him $8,700 in taxes. This is substantially less than if he drew $100,000 from his RSPs instead. Since he was paying such little tax, Mark wondered if he should also be drawing from his RSPs as well. Why not take care of two birds with one stone? So Mark decided to draw $60,000 from his RSPs in addition to the $100,000 eligible dividend from his corporation. As we can see, in this scenario, he'd have a tax bill of $35,000, which is not bad considering he's drawn $160,000. This is an average tax rate of 18%. However, Mark's plan was overlooking one subtle mistake. You might have noticed under both scenarios that his taxable dividend was actually $138,000. This is because when you receive an eligible dividend personally, it has to be grossed up by 38%. So the $100,000 turns into $138,000. This isn't a big issue for the dividend itself because that extra income is offset by the dividend tax credit, thus keeping his tax bill low. But when you add income on top of the dividend, it gets taxed at a much higher rate. So Mark's $60,000 RSP withdrawal doesn't take his income from $100,000 to $160,000. It actually takes it from $138,000 to $198,000. If we look at the combined Manitoba and federal tax rates, this RSP withdrawal is actually going to get taxed at 43% and 46%. At those rates, Mark would be better off leaving his money inside of his registered account and paying 50% tax down the road due to the effects of compounding and the time value of money. With the help of the accountant on our team, we came up with a better strategy for Mark. After looking at his corporate tax return, we determined that Mark would actually be able to draw this extra $60,000 from his corporation as an eligible dividend instead of making the RSP withdrawal. So he would now be drawing $160,000 in eligible dividends, and with the 38% gross up, his personal income would jump up to $221,000. Again, due to the dividend tax credit, a lot of this extra income would be offset, and he'd be left with a tax bill of $27,000. This is significantly less than Mark's original plan. This would also help Mark accelerate his plan to draw funds out of the corporation. Once those funds were depleted, we could then focus on the RSP meltdown because we wouldn't have any dividends increasing his marginal tax rate. In a lot of cases, drawing down your RSPs aggressively makes a lot of sense. But if you're already in a high tax bracket, then it's probably better to just let your RSPs keep compounding tax-free. In this case, corporate withdrawals were the cause for the increase in income. But in some instances, it might be capital gains on the sale of a rental property, investment income, or pension income. Now we're able to get these types of results for Mark due to our Atlas system. It's the exact process we use with clients to help keep their tax bill as low as possible throughout retirement. We take a look at where you're at today, where you want to be, and how to get from point A to point B as efficiently as possible. Check it out using the link in the description. And that's how Mark avoids unnecessary tax today while keeping his RSPs working for him in the future. But when the time comes to start melting down your RSPs, there are ways to do it that can save you a ton of tax over your lifetime. So in this next video, I'm going to walk you through 3 RSP meltdown hacks that can save you tens of thousands of dollars over your lifetime without putting your retirement in jeopardy. You can click right here to watch it now.